Silver has finally crossed $50 an ounce. It feels strange to say those words aloud because for decades, 50 was the line that defined history. The Hunt brothers in 1980, the post-crisis mania in 2011, and then 4 to 5 years of resistance. But this morning, that resistance gave way. Silver is no longer straining against the ceiling. It has broken through it. And if you think that this is just another speculative surge, you have missed the real story. Yesterday, gold passed $4,000. Today, silver over 50. These are not isolated events. They are coordinated signals because together they mark the repricing of trust itself. So let's look at why silver has shot past $50 and what you should do about it. We actually had another video prepared for you today, but as luck would have it, I finished recording only to see that silver had just crossed $50 an ounce. So obviously we couldn't just ignore that. So while we'll post that probably tomorrow instead, I want to share you some super quick thoughts on what we think about this historic move. And before we dive in, we have to give a huge hat tip to Vince Lanci of GoldFix, whose coverage this morning helped frame my thinking and provided some excellent data and insights. Let's be clear about something. Silver is doing what it is doing because the modern monetary system no longer fit for purpose. And the world is questioning the promises on which it runs. And silver, sitting between money and industry, is where those doubts are becoming visible. And there are three main reasons, as I see it, behind this move: safe haven demand, industrial demand, and the structure of the market itself. And together, they tell the story of a system that is starting to fracture in plain sight. The first is safe haven demand. When faith in currencies and bonds erodes or capital looks for alternative anchors, and gold, classic refuge, but silver, well, that moves faster and more violently. And when gold builds a base, silver sprints. And this year, that sprint has been accelerated by the dollar's decline and the growing expectation that central banks will soon be forced to ease again. Now, investors are turning not only to the defensive metal that preserves wealth, but to the smaller, more explosive metal that amplifies gold's message. The second is industrial demand. Silver is no longer, and has never been, just an investment asset. It's a working metal. It runs through solar cells, semiconductors, electric vehicles. These uses are structural, not discretionary. The global energy transition and digital economy both require silver. Every factory building solar panels or batteries is competing with investors for the same ounces. And that double pull on the same resource is what makes this moment so powerful, because silver is the only asset that lives in both the monetary and industrial spheres to this extent, and both are pulling in the same direction. Now, the third reason, and possibly the most interesting right now, is structural stress in the market itself. For months, analysts have watched the spread between New York futures and London spot prices, the exchange for physical, or EFP. Now, normally, futures trade slightly above spot to reflect the storage and financing costs. Now, recently, that relationship flipped. Spot prices are higher than futures by as much as $1. And that inversion, known as backwardation, means immediate delivery is worth more than a promise. And the premium is on possession. Now, Vince Lanci, mentioned at the beginning, calls this the EFP conundrum, and rightly so. There's no apparent shortage of silver in the US, yet London is tight. And the arbitrage, therefore, you would think would be simple. Ship metals London, close the spread and take the profit. But not happening. Either the metal can't move fast enough or it isn't being made available. And analysts like Bob Coleman, Chris Marcus and Daniel Garley have all flagged the same tension, a slow motion short squeeze playing out in real time. And persistent backwardation is the market's way of saying that something is under stress. And what we can't forget here is politics is now in the mix as well. The United States recently added silver to its draft list of critical minerals for the first time in paper. Now, you might think this is just some kind of bureaucratic measure, but in practice, it reframes silver as a strategic asset. And once a metal is labeled critical, governments can justify stockpiling it. They can restrict exports and subsidizing domestic mining. And that changes the incentives for miners, refiners, and even bullion banks. If the US holds more of its own supply while London tightens, the flow of metal that normally balances the EFP can stall. And what was once an arbitrage becomes geopolitical. So when we say silver is at $50, we are really saying that the price of time has changed. Because in a healthy market, time is cheap. you pay a small premium to wait. But in a stressed or stretched market, time becomes expensive and immediate delivery commands the premium. Silver at 50 is the visible expression of that repricing, the market demanding certainty in hand, not credit on paper. And this is not the 1980s speculation or 2011 liquidity surge. This is 2025 and conditions are structural. Supply has been in deficit for over 5 years. Recycling can't fill the gap. Mines face rising costs, regulation, falling ore grades. Industrial consumption keeps rising and above ground stocks are shrinking. London holdings have fallen from over 1 billion ounces in 2021 to under 800 million today. If you strip out ETFs and long-term holdings, the tradable float is closer to 150 million ounces, just possibly a few months of supply. Now, borrowing costs in London have spiked. This is another sign of stress. The vaults aren't empty, but liquidity could be argued to be thin, and liquidity determines price. Will there be a pullback? Possibly. Markets breathe in and out, and no trend moves in a straight line. If bullion banks move metal back to London and lease rates ease, prices might retreat into the high 40s, and that would be consolidation, not collapse. The more significant risk is that backwardation persists and investors buy the squeeze. And in that case, silver could reprice higher again, not as speculation, but as a structural reset. Gold at 4,000 set the frame. It reflected the loss of faith in fiat currencies and the quiet migration of trust from promises to proof. Silver at 50 translates that recognition into the physical world. Gold is the verdict, but silver is the implementation. Gold speaks to the erosion of trust, and silver to the revaluation of function. One shows policy losing control, the other shows industry waking up to it. So these are not separate milestones, but consecutive chapters of the same story. When gold reprices trust, silver reprices utility. And when gold is making the headlines, well, silver confirms the meaning. And the world is beginning to treat tangible assets as the only collateral that truly counts. If the EFP stays inverted, lease rates remain high, and ETF demand keeps absorbing new metal, the floor of this market will likely move upward. Pullbacks will start from higher bases, and the old ceiling becomes like the new floor. Those waiting for the perfect retracement, you may well find the next opportunity never really feels comfortable. And again, I need to thank Vince Lancy at Goldfix, Bob Coleman and Chris Marcus of Arcadia Economics, and Daniel Garley at TD Securities for their work on all of the above. Their work on backwardation, lease markets, and free float depletion really has made it possible to see what is happening beneath the price. Now, for those of you who are wondering, well, what comes next? Remember that in a market defined by scarcity, ownership structure matters as much as price. Paper claims are only as good as the system that honours them. Allocated physically vaulted metal is reliable, and reliability is what this repricing is all about. So yes, silver has crossed $50 an ounce. It's an extraordinary number, but it's not an accident. It's the logical result of years of deficit, some months of strain, and days of growing doubt about what is happening in the wider financial system. Gold has spoken for trust, silver is speaking for function, and the market is issuing its verdict. And if you want help to understand what this means for your own holdings, how to balance silver with gold, how to hold it safely, and how to prepare for what could be a long and volatile revaluation, well, why not just book a free strategy call using the link below and tell the team that I sent you? The price of silver may well be making headlines, but the real story is what it says about everything else.